Hello, everybody. Thank you for joining us for our spring session of Search and Matching in Macro and Finance virtual seminar series. This is our first talk of the spring, and we are very happy to have it today. Greg Gordon presents the roots of self-fulfilling debt crisis. Just so you know, we have several great talks for this spring. So next will be on February 23. Manolis Galenis will present vacancies and recruiting through different channels. Then we have Jose Victor Rios Rules on March 9. We are going to have Sumuda Watugala on April 13, Taiwei Hu on May 11. And if you want to catch up with our previous seminars, you can find everything on our website. Please, Gray, you can take over now and start your talk. Thank
All
you.
right. Yeah, you can see, right? Yes.
Yes.
Okay. Well, thanks very much. This is joint work with Bruno and also Gaston Chamant, who couldn't be here today. Um, so we've persuaded, this is a quote from Keynes, we have persuaded the outside world to lend us upwards of the prodigious total of 3,000 million pounds. The very size of these sterling debts is itself a protection. The old saying holds, owe your banker 1,000 pounds and you're at his mercy. Owe him 1,000,000 pounds and the position is reversed. And what this quote's getting at is that if you owe someone a ton of money, you really need them to repay. And so you're going to do things maybe to protect your position. And that's getting at this paper, as hopefully will be clear soon. So this paper is about self-fulfilling crises, and the conventional wisdom is that self-fulfilling crises arise from coordination failures among atomistic lenders. So it could be lenders expect default, and if they believe that and coordinate on that, then the primary bond auction fails, and then the sovereign defaults. But maybe lenders expect repayment, and then the primary bond auction goes through, and then the sovereign's able to repay. So that can happen, and that goes back to Cole and Kehoe, 96 and 2000. So the puzzle is, though, that real world markets feature large lenders, BlackRock, PIMCO, JP Morgan. In principle, they could buy the issuance of Ecuador or some small country without, they have the resources to do it. So in a crisis, why doesn't a large lender fund the government by buying debt at a discount? And if they fund them well enough, they can keep the default from happening and get debt for cheap. Okay. So our research question is, does lack of coordination alone cause rollover crises? And what we're going to find is no. Rollover crises exist because of a holdup problem affecting large lenders. And so I want to try to get the mechanism crossed right away. The model is going to have 3 periods. The t equals 2 is the last period. It's a standard default repayment given debt. So the sovereign decides, do I want to repay or do I want to default given my debt and endowment? And then in the t equals 1 period, there's going to be an auction. And so how that works is the auction terms are announced. I want to issue this much debt. I have a minimum price of this in the auction. Then after the auction terms are announced, a sunspot shock gets realized, which is a coordination device among or for lenders. And then the auction is going to actually take place, and then default or repayment is going to happen. And so what we show is with a deep-pocketed large lender, a crisis cannot occur here. Why? Well, if a crisis were to occur, the large lender could intervene. He could bid a bit below the good price that the small lenders would be willing to pay in the good equilibrium and make a profit doing that. Now, how much is he willing to pay, though? He's willing to pay whatever the small lenders would pay in the good equilibrium. That's sort of like a break-even price, plus his entire debt holdings. Because if the sovereign defaults, he's going to lose his existing debt holdings completely. So he's willing to pay extra above and beyond what the small lenders would pay to keep the sovereign out of default. And so the sovereign in our model can extract this surplus by using a high minimum price in the auction, holding up the large lender. So the sovereign can charge above the fair price by selecting a high minimum price in the auction and extract surplus from the large lender. Okay, so in T equals 1, a large lender prevents a crisis from happening, but he could get held up in so doing. Now in T equals 0, the first period, it's the same sort of auction setup. Auction terms are announced, sunspot realizations happen, auctions take place, and then default or repayment happens. But now a crisis can occur. Why? Well, in a crisis, if the large lender were to intervene, if he were to buy the debt, the next period in T equals 1, he's going to be exposed and he's going to get held up. He's going to lose by overpaying in that auction. He's going to effectively lose the investment he made this period. So the large lender strictly prefers not to intervene in T equals 0, and that's a holdup problem. And so you can have sunspot crises in T equals 0, even with a deep-pocketed large lender. Sunspot crises are not just coordination problems, they reflect a holdup problem. Okay. So that's the main message. But then once we have that structure, it's pretty obvious that market frictions are going to affect the holdup problem and self-fulfilling crisis probabilities. So we show 3 extensions. One is the introduction of secondary markets. So if the large lender, after buying in the auction, can resell those bonds in a secondary market, then there's no holdup problem because he buys in the primary auction, that transfers his resources to the sovereign. Sovereign now is not going to default, so that uncertainty has been resolved. So now the debt is going to trade at the good equilibrium price, and so that can kill off the holdup problem. But what that means is that if there's illiquidity in secondary markets, that's going to matter now. If markets are really illiquid, it's going to be like there is no secondary market. You'll have a holdup problem. And if markets are very liquid, then you shouldn't have holdup problems and you shouldn't have sunspot risk. Second extension is cost of funds. This is probably the most obvious extension. So this is, instead of the large lender being deep-pocketed and able to borrow at like a risk-free rate, suppose they had to borrow at a spread. Well, if that spread's really high, it's going to be like the large lender can't intervene. It's too costly. And so borrowing costs of the large lender are going to matter for the presence of self-fulfilling crises. And in particular, if you get a shock to large lenders in the US that suddenly makes it more expensive to borrow, like the GFC, the financial crisis, then that's going to potentially generate self-fulfilling crises, not just in Argentina or Italy, but in many countries all at once. It's going to look like contagion, but it's coming from a shock, like a common shock to a large lender. And the third extension is syndicated loans. So if the large lender could commit to keep the debt on his balance sheet, then he's by maybe taking out an illiquid loan or having an illiquid loan with the sovereign, then he's committing himself to effectively bail out the sovereign in certain states of the world. So this isn't like insurance. The sovereign's going to pay more to the large lender for this loan. The large lender is going to keep it on his books. And then if a crisis were going to happen, he's going to intervene to protect his investment. And so some evidence for this comes from Greece, which will show you shifted to syndicated loans as the crisis hit in 2008. So Calvo and Cohen-Kehoe began a large literature on self-fulfilling crises. The recurring theme is that self-fulfilling crises are a coordination failure. And there's some papers out there who've investigated how a nonprofit maximizing institution like the IMF could help select a good equilibrium. What we do is introduce a profit maximizing, deep-pocketed large lender who could eliminate coordination failures. And we show self-fulfilling crises are not just coordination failures. They arise from holdup problems. Self-fulfilling crisis prevalence is affected by anything that affects those holdup problems, like secondary market liquidity, costs of funds for large lenders, syndicated loans versus auctions. We also show shocks to large lender fundamentals cause contagion, like crises across countries. We also present a new empirical measure of self-fulfilling crises, and we provide empirical validation of the model's predictions. So the model is very simple as we could make it. So it's 3 periods, 0, 1, 2. And the sovereign has a deterministic endowment, Y0, Y1, Y2. So YT is the endowment in period T. And it's increasing. That doesn't matter so much. It just generates a desire to borrow. And you can have stochastic. That doesn't really matter. There's some initial debt holdings, B0. Utility from spending, the sovereign has curvature, U, over spending. The expectation here is over sunspot realizations. And there's some regularity conditions on utility. The sovereign issues short-term debt B1 in period 0 and B2 in period 1. Default. So there's a question. I don't know, someone raise their hand? Bruno? You're muted, Bruno.
So the Nugget, you're allowed to talk now, ask your question.
We can't hear you. I don't think we can hear
Yeah,
you.
I don't think you can.
I'm going to
Okay.
keep rolling
Yeah,
while
keep going. Sorry about that.
we work that out. Okay. So default. So before repaying debt BT in period T, the sovereign can default. If it defaults in period T, it stays in default for the remaining time. And delta T is 1 if you defaulted in period T or earlier. Consequences of default, there's some default cost H of Y. And this is all very standard. Okay. So in terms of lenders, there's 2 types of lenders. There's a continuum of small lenders, and then there's one large lender.
Greg, real quick question.
Go ahead.
So they raise this money at the auction. Can they hold on to the money and still default on the maturing debt? Perfect.
Yep,
standard.
hold on.
Yep.
The assumptions, so the small lenders hold all the debt initially, B0. That's not necessary. You can relax that. All lenders are risk neutral. It's also not necessary. They discount the future at rate 1 over R. And in an extension, we'll have that rate be R times 5 for the large lender. So it'll be more costly for him to borrow. Lender utility from consumption, well, that's standard. And there's unconstrained resources, so negative consumption is allowed. Okay, so here's the auction. So the sovereign's going to issue bonds in a primary auction. The auction is characterized by 2 things. One is a desired issuance amount, BG, and the other is a reservation price, Qmin. So the auction could fail. So if there's no Q greater than Qmin that has total demand in the auction greater than BG, then no debt is issued. The auction fails. And so here's my shout out to Gaston, because I think he pointed this out to me. So normally with Calvo type multiplicity, there's like a high interest rate equilibrium and a low interest rate equilibrium, and that's the source of multiplicity, that you coordinate on the high interest rate. So what's the solution there? The solution is you impose a minimum price, right? But ironically here, that minimum price is going to help generate self-fulfilling crises, because it's going to be used to hold it's going to be used by the sovereign to hold up the large lender. Okay. Secondary markets, for now, there's no secondary bond market. That will be an extension. And then there's the sunspot variable, which is a coordination device, zeta t, uniform 0, 1. It's realized after the sovereign announces auction terms, but before the auction takes place. And in a crisis zone, creditors believe a run will occur if zeta t is less than pi. And any pi there is potentially valid. Okay, so we're going to solve the model backwards, starting in period 2, which is very straightforward. At the beginning of period 2, the sovereign has some endowment Y2, some debt stock B2, and a default history delta 1. If they defaulted before, they stay in default and suffer the default cost. If they haven't defaulted yet, then they make a decision, do I want to default or not? If they repay, they lose the debt, or they have to pay off the debt. They keep their full endowment. If they default, then they instead suffer a default cost, but they don't have to pay back the debt. And so the value function is very standard. It's basically an upper envelope of the value of repaying here and the value of defaulting here. And for this presentation, we're going to focus on pure strategies, but the paper allows for mixed strategies where maybe you're indifferent between repaying and defaulting. Who owns the debt in period 2 doesn't matter. It will matter in the earlier periods, but in period 2, it doesn't matter. Okay, so that's hopefully straightforward. Now, this is period 1. And in period 1, you begin with an endowment, Y1, some debt holdings in total, B1, and then the debt holdings of the large lender are a necessary state variable, B1L. B1L, these are, so B1L is in between 0 and B1. And you also have a default history. Like before, if you're in default already, you stay in default. If you haven't defaulted yet, then you announce an auction, which is that desired issuance and the minimum price. Then you get a sunspot realized, lenders bid, then the sovereign decides to default or not. If he repays, does not default, he pays off the B1 and he keeps the proceeds. If he defaults, he still keeps the proceeds. So that was Hal's question, but he suffers this default cost, H. So here are the value functions. And so these W's, these are interim value functions. Those are conditioning on an auction outcome, Q2, B2. And the value, the interim value of repaying, given that auction outcome and your current debt, B1, is the flow value from paying, from consumption that period, plus next period you have option value, you might repay, you might default. The interim value of default is you suffer the default cost, you still get the proceeds from the auction, and then next period you're in default for sure, so you pay the default cost. Now the default policy is just whichever one's bigger of these two, but importantly, default might depend on the auction outcome. So it can be the case in certain states that if you get a successful auction, Q2, B2, you would not default, delta equal to 0. But if you get a failed auction, no debt gets issued. So that's like Q2, B2 equal to 0, 0, then you default. So those are the sort of conditions that you need for a self-fulfilling crisis to be possible, and potentially possible. Okay, so here's the small lender's willingness to pay. This would be like the most, we're going to characterize the most they could possibly be willing to pay. So if they believe that the sovereign's going to repay given an auction that occurs at the risk-free price, 1 over R, then they're going to be willing to bid the risk-free price at anything up to the risk-free price, 1 over R. Okay, and there's the condition in terms of value functions, but I think it's probably intuitive enough. And then if they believe that the sovereign is going to default in a failed auction, then they're not going to bid. Okay, but both of those beliefs could be rational. And if they are, then Q2S is not pinned down. If they think others won't bid, then they won't bid. If they think others will bid 1 over R, then they'll bid 1 over R. And the outcome gets decided by this coordination device zeta 1 being less than or greater than pi. So that's all standard so far. Now for the large lender valuation. Okay, so this is Q2L. This is going to be we're going to characterize their maximum willingness to pay. Well, the large lender, he's large. So he's going to internalize his impact on the auction price and on the subsequent outcomes for the sovereign's default and repayment decision. So the simple case is where the sovereign repays in a failed auction. So this is going to be like a safe zone. And in that case, he's just going to be willing to pay up to 1/r, which is the same thing the small lenders would be willing to pay. There's no uncertainty there about like what's going to happen. He repays in a successful auction and a failed auction. Now, if the sovereign defaults in a failed auction, then the large lender is willing to pay more than the risk-free price, 1/r, if doing so prevents default on its holdings, B1L. Okay. So how much might he, or how much would he be willing to pay? Well, if the sovereign defaults, he gets 0. So he loses the entire stock of debt, B1L, and that's why there's a 0 here. But if the sovereign repays, then he gets paid out his existing holdings, B1L, and then he loses this, which he gives to the transfers to the sovereign this period. And then next period, he gets B2. So, but that's discounted by R, 1/r. Okay, so if you solve for Q2 from this, he's willing to pay up to the risk-free price plus his existing holdings, B1L, divided by B2. If that prevents default. So if at this price, Q2L here, if that prevents default, so he repays given that price, the value of repayment is greater than the value of default, then he would be willing to pay up to that. Okay, I hope that's clear.
But just
so
to be clear,
yeah.
The amount of new debt must be small enough so that he's not going to default for sure tomorrow.
Yes.
So that puts a cap on B2. All right.
Yes, you're right. I think that's implicit. Yes. Not very clearly stated.
So
yes.
Related question. So okay, so V2 has to be such that they repay in the last period. But is that obvious that V2 must be all held by the large lender?
Well, here, okay, so you're saying could there be a mix of the small and large lender holdings?
Yeah, so the BlackRock comes into Argentina by 75% of the debt, that the rest is held by someone else.
So in T equals 2, who holds the debt doesn't matter for the default decision. So it doesn't really matter. Here we're considering the case where the large lender or the small lenders are coordinating on a failed. So think about it as the small lenders are coordinating on the failed auction, and the large lenders, we're characterizing how much would the large lender be willing to pay to step in that case. If it's good equilibrium, he is just indifferent between bidding or not. The sovereign's not going to default.
But the assumption is that if the large lender steps in, they are the only ones buying the debt.
It's not really an assumption. It's more like given the bid strategies of the small lenders, it's either they're going to repay and then the sovereign's indifferent, or they're not going to, either they're going to bid and then the sovereign's indifferent, or they're not going to bid and then this is like the relevant characterization.
Great. You could also think about the following: is they hold the auction, I think, and the sovereign, I mean the large lender, buys up a bunch of this debt, but they could turn around and sell it. It doesn't matter, as you said, it doesn't matter who holds it, this period 2 debt.
Yeah. So as an extension, we're going to have this resale market, which is not here yet.
But that won't screw things up for this debt.
Equal 1, yes.
Yeah.
0, it will matter, but not for T equal 1. Yep.
Just to clarify, so the assumption, it doesn't really matter as was pointed out, but the assumption in the auctions that this is a uniform price auction. So if B1L is strictly greater than 0, and say they put the auction design would tell you to put a minimal price that has a markup, then small lenders will not bid anything at this value, so the large lender would win the auction by everything. If B1L is equal to 0, then they would both be indifferent. So you could have all of them bidding this, and then it's a uniform distributed based on their size.
Yeah, thank you, Bruno. That helps a lot. Thank you.
I'm glad Bruno's here. Okay. So the key difference between small and large lenders in the period one auction. So small lenders, they can have multiple equilibrium prices, potentially 0 or 1 over R, based on beliefs, so sunspots. But for the large lender, its willingness to pay Q2L, it's unique. It's pinned down from the above, and it avoids, like, there's no coordination failure with that. He knows he's like buying all the bonds in that world. Okay, and note that Q2L, the most the large lender is willing to pay, is greater than Q2S, what the small lenders are maximally willing to pay. And it depends, how much he's willing to pay depends on B1L. That's like the key sort of thing for the holdup prop. Okay, so this is a graphical illustration of the regions in T equals 1. So this traces out B1. So this is the debt holdings in T equal 1. And if there's very little debt, then you're in this green region, which is the safe region. So you're going to repay even after a failed auction, which is this condition. And it's just not worth defaulting. For example, if your debt's less than the default cost, if you default, you lose more resources today and you lose option value of defaulting or repaying next period. And so that cutoff region for the safe zone is B1 lower bar. Now, so in the outcome there is repayment. There's no sunspots, no holdup. Now I'm going to jump over to the right, which is like the high debt region. This is where default occurs even if the large lender bids its maximum price Q2L. So this default zone is they default even if they get the Q2L, which is bigger than Q2S. So let me just walk through two cases. One is the case of B1L equals 0. So that's the large lender doesn't own any debt in period 1. Then the max price he's willing to pay is the risk-free price, 1 over R. And that's what's drawn here. So this region coincides with this normal co-Kehoe default zone, and it's B1 bigger than B1 upper bar. Now, if B1L is strictly positive, then the max price the large lender would be willing to pay is the risk-free plus this B1L over B2. So it's strictly bigger than the risk-free price. And this region is not drawn. It's smaller than the usual Cole-Kehoe zone. So this pink area would be smaller, begin over here maybe. And the outcome there is default. Now, the interesting world is the rescue region, or you could call it the holdup region, because usually both are true. This is where you default after a failed auction and you repay if the large lender bids Q2L. Okay, so if there were no large lender, so if Q2L were 0, this would be the normal sunspot region, Cole-Kehoe sunspot region. What is the outcome in this case? The outcome in this blue region, this rescue region, is the large lender is going to intervene to protect legacy debt, B1L, because he knows if he does, he protects his debt stock. He's willing to pay up to Q2L here. The sovereign exploits that by setting the auction price minimum to Q2L, or, like epsilon below that, sort of working up. And the large lender in total then is going to overpay. So the fair price is like 1 over R. That's what the small lenders would be willing to pay. He's going to pay Q2L minus 1 over R per unit of debt, and he's buying B2 units of debt. How big is that overpayment? It's B1L. Okay, so in the blue region, the large lender is going to intervene. Repayment will occur. There will not be a sunspot crisis, but crucially, the large lender is held up by the sovereign and loses all its B1L position. Okay, so that's why you could call this the rescue region or the holdup region. Okay, so please take note. So this B1.
Can I ask
Yep.
you a question, just how to think about this?
Yep.
In some sense, all of these lenders, they gave you some stuff last period, and now that's sunk.
Yep.
But what we have going forward are these default costs. And so, and also the desire of the sovereign maybe to smooth their consumption.
Yep.
And so you have that, though that's what you got to play with in terms of rents to pool around. So when you're talking about this in some sense, yeah, they're extracting rents relative to my lost fixed costs, but it's these default costs that we're sort of playing around who gets to keep those going forward, right? How we divide those up. Because that's the rents on the table that's left.
Well, it's not just the default cost, like the H. You mean the H of Y?
Yeah.
It's not G. It's not just that, but it's
There's
also
also the intertemporal smoothing, but that's all that the sovereign has left to care about.
that the sovereign. Yes, that the sovereign does. Yeah.
Right. And so, in some sense, how do the rents of getting that stuff, how is that going to be allocated?
hmm But the total surplus is bigger than that. In that, like the B1L, right? This is the surplus of the large lender if the sovereign repays. He gets out the B1. Well, no, but then the sorry, you're right. Then the sovereign loses the B1L.
Right. So I'm just thinking, what is it they're really able to negotiate? At some level, it's this, you know what I mean? The
Yes,
incremental.
I hear you. Yep. Yeah,
So
that's right.
we work at some point an extension where instead of having the auction with the large lender, we have the auction with the small lenders, and the large lender goes and bargain with the sovereign after the auction, which also kind of works in a similar way because if the small lenders anticipate the bargaining, they are going to be this knowing that there will be no self-fulfilling crisis because of the bargaining after. But in that version, you could actually put a Nash bargaining uh, coefficient so they could split the surplus. The way if you model the way we are modeling now, it's equivalent to always give all the bargaining power to the sovereign. So the large lender gets indifferent between default or not.
Yeah. Okay. Good. So the period one solution, just to summarize, a deep-pocketed large lender always eliminates sunspots, but in doing so, it gets held up, effectively losing its entire debt holdings. And so now we're going to go to period zero, and we're going to show a sunspot crisis can occur. And the reason is the large lender won't intervene when it would be held up if it intervenes. And so that's the holdup problem. So this is the period zero. The sovereign's going to announce the auction terms, B1G, Q1 min. Then the sunspot gets realized, the lenders submit their bids. Then the sovereign decides to default or repay. If he defaults, he loses the default. He pays the default cost H. He keeps the proceeds of the auction. If he repays, he gets the proceeds of the auctions, but he has to pay out his debt. Okay, so here's the holdup problem in a nutshell. So suppose the sovereign tries to issue B1G that is in the P1 holdup region. So what I mean is if you come back here, imagine he's issuing a B1G that's inside this blue region, in between B lower bar and B upper bar. Okay. Then we know that the sovereign's going to induce the large lender to bid Q1L equal to the risk-free price plus his holdings divided by B2. So what is the period zero payoff to the large lender of buying B1G, setting B1L equal to B1G? Well, the payoff is he's going to transfer these resources to the sovereign Q1BL, so he loses that. Next period, he's going to get paid back because there's going to be a rescue or the holdup. And so the B1L is going to be paid out, but he's going to transfer resources to the sovereign in the amount Q1L B2. And so here I plugged in Q1L, it's 1 over R plus B1L over B2. And so this would be the flow next period. And then after that, B2 has to be consistent with repayment in the second period, which was sort of asked earlier. And so 2 periods from now, he gets B2. Okay, but if you look at this and just start multiplying things out, everything here and here cancels. Okay, why? Because the sovereign is extracting all the debt holdings of the large lender. He's getting the entire value out of that. So the large lender gets nothing from the second, from t equals 1 on. So that's why this is all 0. And then all that's left is the initial transfer in the auction, Q1 B1L, but that's a transfer. That's money out the door. So the payoff is strictly negative. Payoff strictly negative. So this is a holdup problem. In period 1, which is here, the sovereign extracts the entire surplus from the large lender's P0 investment. That's this overpayment term here. So in period 0, the large lender is unwilling to invest in the debt. Why would he buy the debt? He's just going to get ripped off next period in this setting where B1G is inside that holdup region. So this is also the zones, but this is for t equals 0. And this is not the value function. This is the bond issuance policy. And I'll want to walk you through this. So a simple case first. So x-axis is the initial debt holdings B0. And say those are really small. Well, you're in the safe zone again, right? Like if you would never default because you would lose more than it's worth. Even in a failed auction, you repay. Okay. Now, as B0 goes up, because of consumption smoothing, you're issuing more debts. So B1, your issuance amount given B0 is going up and up and up. Now, at some point, you get to B lower bar 0. This cutoff is where now default is preferable after a failed auction. So this line here is where default starts becoming preferable after a failed auction, but repayment's still preferred in a successful auction. Okay. So just above this, crucially here, that bond issuance at that B lower bar 0 is below B lower bar B1. What is lower bar B1? This lower bar B1 is the start of the holdup region. Okay, so in this case, the sovereign is issuing debt that puts him like here in the safe zone next period, not the holdup region. Okay, and so in this, like in here, the large lender knows if he bids, he's not going to get held up next period. He's not going to be in that zone, and so he's willing to bid. So there can't be a sunspot in this blue region because if there were, the large lender would intervene and buy the debt and would not be held up next period. And so there can't be a coordination failure there. That's why we call it the rescue region. Now, once you go, your debt's even larger. Well, now you get into, now B1 is in between B1 upper bar and B1 lower bar. This is the crisis, the holdup region. Okay, so now if the large lender intervenes, he's going to be held up next period. So that means he has a strictly negative payoff from bidding today. He is not going to bid. And so that's why this is the sunspot region, because after a failed auction, the sovereign defaults. After a successful auction, the sovereign repays, and the large lender is not willing to intervene. So either outcome is possible. Okay. So this is like the key of the paper is because of the holdup problem, a large lender does not necessarily eliminate sunspot risk. It does not eliminate sunspot risk. Now here you see it does reduce the sunspot region. So because there is this rescue region here, but a sunspot is still possible. So sunspot crises are not just coordination failures. Okay, and then just to finish this off, if your debt's really high, you're going to default, even if at the best possible price. So that's this red region. Okay, so that's the main thing. Are there questions here?
So I have one small, maybe silly, but so the sovereign would love to be able to commit to give some bargaining power to a large lender, right? That So if I'm Argentina, I'm bargaining with BlackRock, I go and tell them, look, tomorrow is going to be just the two of us. We sit on the table, we split profits, we do something like that. So that will help them, right?
Yeah, I think so. Yeah. If they could commit to not hold up the sovereign or the large lender next period, that would help. Yeah. Some
So this,
mechanism that.
yeah. So some price Q2 such that the sovereign wants to repay, but it's not above the Q2L. This probably is, yeah.
Yeah. Yeah. So what we're going to do is look at extensions where it changes how much the large lender can be held up, essentially. So so three extensions modify this core mechanism. First is secondary markets. So in that extension, what we do is we assume that immediately after the auction, the large lender can, or all the lenders participate in like a well-rationed debt market, and the large lender can sell up to a share alpha of his purchased debt. And the result is that this lessens the holdup problem. Okay, so in the extreme, imagine he can resell all of his debt alpha equal to 1, then he prefers to do that. So if after he transfers the resources to the large lender, now the large lender is not going to default. That's known. He's not going to default that period. And so that uncertainty is off the table. The price of the debt now in the secondary market has to equal the good equilibrium price according to like the large lender bid, the risk-free price in this simplified world. And so and by selling the debt, the large lender has a better value because he's not going to be held up next period. And so all the debt gets resold.
Right, can I ask you a question on this?
Yeah.
So it depends on how we think these secondary markets work. I mean, here you've got this instantaneous transfer. No one's able to condition what's happening based on what I'm doing. But if we sit there and say I'm gradually selling or in a way where I have to, put my offer out, then people are going to be sitting there looking at it. Oh, wait a second. He's dumping his holding. The price after he sells, the value after he sells of the debt will be lower than before he sells.
So the fundamental value is the same, I believe. So like in because
I don't think so to the small guy buying it, because now that you've dumped it, you're the big guy. Now that you've dumped it, I've got the sunspot crisis worried about going forward. If you don't dump it, then they're going to be able to hold you up, and we won't have a sunspot crisis. So if I'm sitting there holding on to a little bit of this debt, I think the value changes.
So after the T0 auction, like the result for T equals 1 is there's no sunspot for sure, right? And so there's not going to be a sunspot in T equals 1. So in the secondary market of T equals 0, that's taken into account. That was true for any level. The key is that was true for any level of debt holdings of the large lender, whether he had a lot or a little. There can't be a self-fulfilling crisis in T equals
Oh,
1.
I see, because I'll still step in, you're thinking?
Yeah, he'll still step in. Yep.
Just one thing that maybe what Hal is saying could be true if there was uncertainty about the future state, but because here everything is deterministic, there's not something like that going on. But in the appendix, when we put the endowment shocks, then there could be something like that because you don't know exactly in which region you're going to land.
Okay. So some testable predictions from this are that large lenders should have little exposure. If they can get to little exposure, they should do that. And another prediction is that liquidity problems in secondary markets should increase sunspot risk. Okay, we're going to test that later. The second extension we do is funding costs, and this is like the most obvious one, I think. So if you make it more expensive for the large lender to borrow resources from the future with this R of phi greater than 1, you're going to reduce the size of the rescue region. If you go to phi infinity, it's like the large lender doesn't exist. Okay, but the testable prediction of that is that larger countries have more risk. Now, why did I say that? Sounds like a non sequitur. Larger countries have more risk because it's harder for a large lender to buy that's a bigger stock of debt. It takes more resources. So if they have convex sort of funding costs, it's going to be more costly for them to intervene. And so you're going to be more likely to have sunspots for large countries in terms of that debt stock. And then the second prediction is if you have like a shock to the borrowing costs of banks, maybe their default risk increases all of a sudden. That's going to make sunspots risk present in like multiple countries all at once. Last extension is syndicated loans. So there we assume the sovereign can either choose to auction, as he's been doing, or can make an illiquid loan offer to the large lender, something that the large lender can't move off his books at all. And what we find is such a loan is expensive, but it commits the large lender to being held up, and so it reduces sunspot risk. So really it acts like insurance. I'm going to pay a premium to issue like this loan to you, or to get this loan from you. You're going to keep it on your books. And if a sunspot would happen, you're going to intervene. So it's like insurance. And the testable prediction is that syndicated loans should be more expensive and used when sunspot risk is high. And so we're going to test these predictions and find they all hold. Okay.
So Greg, can I ask you why it is called syndicated loan? So usually it's called because there's a group of lender rather than a single one.
Yeah, it's organized like it's like a group of large lenders, a couple, and maybe they split the loan half like among two parties or three parties. That's my understanding.
So this is not happening here.
Well, so formally we modeled the large lender as like one, but loosely we think of it as like cartels. Yeah.
Or maybe like maybe the argument could be okay, it is syndicated, so it is less liquid. Maybe something like that, because you have to talk to everyone in the syndicated loan. That's why it is difficult to get rid of from the balance sheet.
That's it. That's a good point. Okay, thank you. That's Russell, right? Sounds like Russell. Okay. Thank you. Okay, so some approaches to measuring sunspot risk. One is purely empirical. And the idea here is self-fulfilling risk is unexplained by fundamentals. So what you do is you take a measure of default risk and then you regress it essentially on some fundamentals. The residual of that should be non-fundamental risk. That's the idea. Or you proxy, you do a similar idea, but exploiting like cross-country movements in these non-fundamental sort of risk. A second approach is narrative evidence. So you look at sharp movements in default risk associated with policy backstop announcements or some event where you think you know why they moved, and that reason is not like because GDP was lower. And the third approach is model-based identification. So that's where, in the model, agents know the structure of the model. They know how much self-fulfilling risk is, whether they're in the crisis region. So then you use the model predictions to infer the risk. So for instance, Bacall and Dovis, their identification strategy was exploiting maturity choice. And faced with a crisis, the sovereign should go longer in maturity. This goes back to Cole and Kehoe. So you can infer the sunspot risk from maturity choice. And so we're going to use all these methodologies and find the data agree with the model. Okay, so our direct measure of self-fulfilling risk exploits that default risk volatility in small windows is less contaminated by fundamentals than in large windows. So the idea is if I look over the last week and spreads were really volatile, there probably wasn't much news that was released in the last 7 days, as opposed to like in the last 90 days. So if we look in short windows and there's a lot of volatility, it seems like it's non-fundamental risk that's driving that. So we rely on daily CDS prices. We have mid, bid, and ask prices for a panel of countries. We convert those into IDP, which is a 1-year implied default probabilities for each country K at each date. And then we define weekly volatility, vol IDP, for each country for each week. And that's going to, after we control for fundamental risk, that's going to be our sunspot risk proxy, vol IDP. And we also compute the weekly average mid IDP and the weekly average bid-ask IDP spreads. And we think of the mid price as reflecting the, it's a high frequency measure that incorporates fundamental risk, any fundamental risk, and then it might also incorporate non-fundamental. But if we strip vol IDP of that sort of IDP factor, then what's left over should be non-fundamental is our approach. Okay, so I want to try to convince you that this is a reasonable measure. So in the red, this is a time series. And in the red is our vol IDP, our IDP volatility in these short windows. And then in blue is the average log IDP, implied default probability. And the vertical dashed lines represent like key dates that we picked out. And so a couple things, and this is cross country. So we compute this for every country and then average across countries to get a single time series just to plot. In the data, it's disaggregated. So one thing you can see is that the IDP volatility, it's often disconnected from the average IDP. So for instance, if you look, like sometimes IDP volatility can fall really fast and IDP itself is like basically unchanged. So already that suggests that vol IDP, the IDP volatility, by virtue of a narrow window, is mostly non-fundamental. We also do some robustness where we try to strip vol IDP of any like IDP related factor like IDP squared and these sorts of things. So I just want to walk you through like 2 episodes. One is an episode you know too well, which is COVID. Okay, and so that's these 2 vertical lines here. February 21 of 2020 is the first vertical black dashed line. That's the first Italian COVID death. And you see IDP jumps, really, it jumps. And that's signaling, well, COVID had some fundamental risk associated with it. Vol IDP also jumps with it. Now, what about March 23? Well, that's, you see that vol IDP starts, it drops like a rock after that, but IDP itself doesn't change. So how we interpret that is this, March 23rd is when the Fed announced QE was going to be unlimited, that there weren't going to be any hard caps on how much the Fed would buy. And so how we think about it, that is this backstop, this QE backstop, which benefited large lenders, among others, moved vol IDP tremendously, suggests vol IDP is capturing non-fundamental movement as well as fundamental. So there's another episode here from the European debt crisis, but I'm running a little short, so I'm going to skip it. Let me just say that the vol IDP is high precisely when Bacola and Dovis find the largest contribution of self-fulfilling risk to Italian spreads. So in the period where they're like, oh, here's self-fulfilling risk in Italian spreads, that's right here when vol IDP is high. Okay. And there's other narratives, but I'm a little short, yeah. Okay, so here we run a regression with the dependent variable being vol IDP, and then a bunch of explanatory variables as listed. So we control for lagged log IDP here. So this vol IDP measure, once you partial out the, or control for log IDP, now you should have purged it already if like fundamental risk is the goal. The reason these are lags is because there's actually like a VAR specification that sort of underpins this, but that's not so important. So some testable predictions. I told you that there should be more sunspot risk, higher vol IDP here, if it's a larger country. And you do see a positive coefficient on log GDP. Okay, you don't see it here in the second specification, But here you put in country fixed effects. Okay, so the reason it goes away is because the country fixed effects take away the size effect. And now what you're left with is cyclical movements in GDP, and those are negatively correlated with default risk. And then higher interest rates, you see the 5-year treasury yield, you increase that, it's more costly for the large lender to intervene, vol IDP goes up. And then higher bid-ask spreads, you can see larger bid-ask spreads at a country level are associated with higher vol IDP. So again, that's correct from the model perspective. And then higher phi. So phi was the borrowing premia of the large lender. So for us, we think of that as lower distance to default for these banks. So they're closer to default. It's more costly for them to invest in Argentina when their housing portfolios collapsed. And so we expect a negative coefficient here, and that's what we get. And also note that this distance to default measure is a US specific versus this is a panel of countries. And so of like 40, 45-ish countries. And so what this is saying is there's an aggregate component where bank distance to default, if that goes down, large lenders get closer to default, then risk kicks up in a bunch of countries all at once. Okay, some other testable predictions. Large lenders should carry little exposure. So in our previous work, we were looking in Argentina, and we had confidential supervisory data where we could see the bond position and the CDS net position of large lenders. And what we found was large lenders intermediate huge amounts of CDS, but they have very little net exposure. So they don't expose themselves, so they shouldn't be subject to the holdup problem. That's the prediction of the model, and that's what we found for Argentina. Second prediction, syndicated loans should be more expensive because they're less liquid and expose the owner to holdup risk. And this is a robust finding from the literature that looks at that, like Gupta et al. And the final testable prediction is that the sovereign should switch to syndication if a crisis occurs. And so we don't have good data for most countries of like they auction this much, they did this much syndication. But for Greece, we have for each auction, which is in the green triangles, or syndication, the blue, and a few private placements in the red diamonds, you have the interest rate that prevailed for that. And so here we've subtracted off the German yield to get a spread relative to Germany. Think of them as being risk-free. And so early on in the 2000s, it's like Greece is priced sort of risk-free. And they use both types of debt. They use syndication, they use auction. And from the model perspective, that's fine because they're indifferent. If there's no default risk, if there's no risk of being held up, the large lender's happy to buy the debt just as much as the small lenders are. And so we'd expect some mixing. Now, once you get to 2008, you notice that all the syndication goes away. You only have auctions. And so once risk perceptions increase, you switch to just auctions. From the model lens, that's saying syndication maybe is expensive, but sunspot risk is low. So they're still going to the auction. At first, they're getting good prices. But then when the auctions start to blow out, you get 2 bad auctions, then they switch completely to syndication and private placement. And so from the model lens, what's happening is sunspot risk kicks in, and they use syndication either as insurance against self-fulfilling crises in the future, or possibly they're being held up here. And actually rates might be artificially low relative to what they should be. And maybe that's the case because these are pretty low spreads. And the default happened shortly after this. So in conclusion, self-fulfilling crises are not just coordination failures. They also reflect a holdup problem. Intervention by the large lender creates a willingness to overpay next period. The sovereign exploits that ex post, and that eliminates large lender incentives to bid ex ante. But we also, in extensions, highlighted 3 frictions that determine crisis risk: secondary markets, funding costs, and syndicated lending. And the data support the hold-up mechanism in these frictions as roots of self-fulfilling crises. So thank you very much for listening and attending.
Yeah, thanks, Gray. That's great timing. So now we are gonna have 15 minutes of Q&A, and for the panelists there, you can just ask any question and unmute your mic, and don't need to just say anything. Thanks.
Hi, I'm Milena over here. I have a question about the role of intermediaries. So in most countries, as you know, there is a primary dealer system where primary dealers of the large banks are obligated to buy debt from the government, and they get some benefits and returns. Uh, I'm worried, or I asked for 2 reasons. One, would there be a model extension where you could add an intermediary that perhaps is balance sheet constrained or have some reason why it not necessarily always kicks in? And if you could do that, could you tell us how in what shape the intermediary has to be in order for your hold up problem to still go through? And then 2, when you go to the empirical testing part of the paper, do we want to control for how strong the dealership system is in each specific country? Now, I don't know which countries you have exactly, but I think in some they have other obligations than in some others, and that seems to be important for when to think about whether auctions might even fail or there's any of that type of risk.
Yeah. So that's it is interesting. I mean, I think of the primary dealers as being large lenders. Now, you're right. There are these institutional features, like if no one bids in the auction, they may have to take it, which sort of strengthens, if anything, the position of the sovereign relative to those dealers.
Yeah. So one way to think about this is you talk about like, well, you need to apply to be a primary dealer. That's some benefits of doing so. So that's the way I interpret this is, well, you have to buy these bonds, and you potentially face this risk of end up with this bond on your hands if there is a crisis, and then you weigh that against these benefits. So it's kind of an indirect payment. So it's like in our case that we were saying, well, you if you want to, sometimes for the sovereign it's beneficial to do a syndicated loan, even though they get like a higher interest rate. So this would be a way of, it's like you are getting high interest rates relative to the small lenders because you're getting these additional benefits.
Yeah.
So that's my way of seeing this. And if you believe the country is going to default no matter what, then why are you applying for to be a primary dealer? Yeah.
I think it is interesting. I don't know of a data that like characterize. I guess it's out there, but characterizes the like I don't know how much of a factor the primary dealers are in those auctions, like whether they have to constraints on that. But it would be interesting to investigate empirically, because I do think you're right that like that sort of institutional feature could matter for the sunspot risk. Now, we do sort of, we realize we're missing things in the empirical specification. So that's why we include like, I might not have talked about, but the 3rd specification was like country by quarter fixed effects for, so that's like a very rich set of fixed effects. So the goal there is to try to take care of some omitted variables like that primary dealer structure. Yes. Hey, Jacob.
Hi. This might be a little bit too abstract a question or too high level. for what exactly you're trying to do. But um, some of these entities, institutions that you're hoping will act as large lenders with the deep pockets, um, they need to get their capital from somewhere as well, right? It's not as if BlackRock just has, is swimming in cash that they can deploy, anywhere that they want.
Right.
And so, um, eh, what are your thoughts about where, how these large institutions are actually able to finance these sovereigns, especially and still be immune to the same kind of problem that when a crisis hits, if they get too far over their skis and lending to a bunch of emerging country sovereigns, then it may actually enhance the contagion.
Yeah, that's right. Yes. So, okay, a couple things there is there's some models of contagion. They literally have the mechanism is there's someone defaults in this country and it literally reduces the worth of like the books for the book value for the large lender. And that can then make it more costly to intervene elsewhere. So for us, that's all sucked up in this phi parameter, which is like this borrowing spread. Where does it come from? Well, partly could be retained earnings. They keep it themselves, and so then they forego the opportunity cost of investing in whatever their next most profitable project is. Or it could be literally they go and issue debt, or they do equity issuance, those sorts of margins. Did that address everything?
I don't know if you remember that when you started this paper, we actually were modeling this as like a bank coalition. So we would have like kind of a separate game for the small investors to collude, and then the size of the coalition was the parameter that we were playing around. And then it becomes a little bit like goes in the direction that you want, but then we thought that it was better to emphasize the hold up problem and make the coalition just one single agent. But the way we start thinking about this was more like in the lines of what you're saying. Like we have a lot of investors and they can coordinate on say put the money on a hedge funds that's gonna rescue will rescue Argentina, right? And the question is how this coordination works. So we could model that game. It's I think it's kind of like something that we need to think about in the future, because all these institutional things matter. How can we put the money? How much control will we get? Right? So like that.
Okay, thanks.
If I were more of a central banker, I would say repo and reverse repo and all these things, but that's I might be pretending I know something I don't.
That seemed to have worked really, really well at times. So.
Okay.
Hi, I'm Fabienne from the Bank of Canada. I had similar thoughts as Milena with respect to these primary dealers who are currently not in the model setup. And I was thinking myself, okay, what would happen? But I was a bit stuck with this Q minimum, which somehow interferes with them having to bid because, well, that would mean they have kind of a minimum price given. So I was wondering, I think first, is this minimum price something that is there as such in reality? And if not, I was wondering if that might not be what the primary dealers are somehow providing in the auction, that they are actually setting kind of a floor because they have to bid. Maybe you can comment on that.
Mm-hmm. Well, one thought is, in some ways, it's really like a stand-in. Like Bruno mentioned to Hal, a different way to set it up is if the auction fails. So say there was no minimum price in the auction, like you didn't have that as a tool, the auction could fail. But then if you could then approach the large lender and negotiate terms, you would have something like this. this minimum price, what it effectively does is puts all the bargaining power in the hand of the sovereign, but you could relax it and have like a just like one-on-one negotiations between the sovereign and the large investors. Is it like an institutional feature? I think that probably varies by country, but maybe Gaston knows better. I mean,
some auctions do have a minimum price, but yeah, as Gray is saying, it's more of a broader interpretation of bargaining between how to extract these rents that Hal was pointing out, of avoiding the output cost of defaulting, and then you could have a more sophisticated way to extract, or more detailed way to extract some surplus from the large lender. Could be bargaining by directly issuing debt to them. So yeah, it's a little bit of a way to implement some rent extraction in the model. You could think of it in a different way too.
Okay. Okay, yeah, this actually helps in terms of interpretation. Thanks.
So just kind of like just add something to that that might be interesting. Like in this version that we are keeping, there is no stochastic GDP shock, right? Like it's all the sunspot. But like once you have actually GDP shocks, there is a reason why you want to make sure you want to keep the bonds in there's a fundamental reason to keep the bonds in the hands of the large lender, because the large lender also provides insurance. So when you have a negative GDP shock, you can extract surplus from them in certain states. So what I'm saying is like once you account for that, it does make sense that you have an ex-ante agreement with a large lender to say, hey, we are going to set up a price in good states. You're going to buy these bonds in the auction, sell to as an intermediary, put a markup, and sell to the small lenders and make a profit. In a bad state of the world, you are gonna buy at this minimal price that I set up, because that's how you syndicate this primary dealers work. They are gonna buy this and they won't be able to sell, and they are gonna get stuck with that, right? So and that's kind of a way to extract the surplus, and you want to do that ex ante. So there is a way to rationalize that. Now it's kind of like a speculation here because we didn't solve the model like that. So it's kind of but there is this room where that's our third extension of the syndicated. So there is this room to pay a premium before some GDP shocks. You want to pay a premium to get bonds in the hand of the large lender. That's beneficial to you. And the large lender, even if he's breaking even, it's good for both parties. So I think like we are good with questions, and we run our 15 minutes. Thank you, everyone. Thank all the panelists for coming and joining us today. Like this was great. I appreciate all the feedback, all the questions, and please join us February 23rd for Manolo's talk. And I will stop the recording now, but please, if you want to stay a little bit longer and hang out and just have informal chat, feel free to do it. Thank you. Have a nice day.